Thank you very much for the opportunity and good morning, everyone. Can you hear me? Hello?
Yes, we can hear you.
Okay, that's what happens when you are back. You start having issues. Okay, so I can't see my slides, so I'm also going to just walk through what I have here. I thought it would be shared on the screen.
Yes,
so
it will be shared shortly. Can you see it now?
Okay. Let me see. Yes. Okay, good. Thank you. Yes, so let's move. We're going to try to be fast, but I'm sure you won't miss anything. So let's start the presentation, please. The next slide. Hello?
Yes, we've changed it to the next slide.
Okay. I don't know why I have a drag here. I'm still seeing the first page. Okay, yes, thank you. So put simply, like the introduction says, companies raise capital by selling their shares to investors. Sometimes you have angel investors, you might have equity, private equity investors as well, or you're selling to the general public that wants to, that you market your shares to, or other loans and debt instruments that you want to use as a way of raising your capital. So we don't want to, I've tried to streamline this so we don't go into different types of products. We won't be able to do justice to this paper. Can you go back, please? Can you go back? Yes. So this session will focus, no. The next one. Thank you. Yes, so this session will focus on raising equity capital via public offerings and borrowing via the debt capital markets. That enables us to tackle the two areas easily. And then we'll also be looking at due diligence, because once you're carrying out these activities, the lawyer's role, above all else, is to ensure that the transaction is compliant with the requirements of the SEC and other regulators involved in the transaction. I'm also happy you took up corporate governance and arbitration yesterday, because they also, you also have to be aware of how those principles impact. Because basically, when you're selling your shares or you're approaching the market for people to purchase your securities, because not all of them have high net worth individuals or institutional investors that have the kind of skills to analyze your documents and understand your products. The disclosure regime of the Securities and Exchange Commission require you to give adequate information. And what people are going to be judging you on is your financial history, the corporate governance, the kind of board, the management team, all these things, and your previous performance, because that is what dovetails into what you're going to do in future. They want to be able to analyze this information. And if you don't put out, if you're not a listed entity, for example, that means you will not have publicly available information that people can look at. It then means that you have to ensure that what you're giving out, you give out material information and you give out all information required to make such a decision. So let me not go into it too much. So next slide, please. Yeah, so capital markets are responsible for connecting persons. Sorry, trying to move my screen. Okay, who require capital to those who have it. So those who require it want it at the least cost, whilst those who provide capital expect to make a profit from their financing efforts. So the capital markets are a critical part of the financial services sector of any economic pattern. So capital markets promote economic growth because they provide companies and governments access to capital, which allows these entities to invest in businesses, create more jobs, and build necessary infrastructure. I'll try not to read through so that we'll have a conversation. Go next slide, please. So As simple as it sounds, because there's a structure in place, it may involve the following startups, investing in new and innovative ideas, operational requirements to boost operational needs for those companies who need capital for their operational needs. So you might have you have the staff, you have the business going on, but you just require maybe capital to buy your raw materials and a few other things that will enable you to meet the demands. You can approach a bank, you can get capital injection from the shareholders, also expansions, strategic mergers or acquisitions. This is also one of the ways to go. Please, next slide. So the key players in the market, exchange listed companies. For the OTC, you also have those that are not listed. They might be public companies, but they're not listed on the exchange. But you are able to trade their shares in over-the-counter exchanges like the NASD. So you have investment advisors, which are usually the banks, merchant banks. They also have these advisory licenses. You have solicitors, mutual funds, exchange-traded funds, broker-dealers, and other registered entities. You have the retail and institutional investors that I referred to earlier. You have the Securities and Exchange Commission. You have the NGX Limited, which you all know as the Nigerian Stock Exchange, but with their restructuring, they're now known as a different name. You have self-regulatory organizations. So, for example, we'll say the NBA is a self-regulatory organization. You have association of registrars. You have the bankers. So many of these organizations also play a part in the market. The SEC also expects them that if they have erring members, maybe they sold a product that is not regulated or they've done something or some AML infractions, most of the time, those self-regulatory organizations will also penalize you, sanction you, even simultaneously with the SEC. And it is also a means of dissemination of information faster, because the regulators can also send notices to these SROs and they make sure that it trickles down to their members quickly. And of course, you have PENCOM, which is the Pension Commission. And for most capital market transactions and capital raising exercises, the PENCOM is a very important body because, you know, we have this huge pension capital. Nigerians have been contributing since the Pension Reform Act, the new Pension Act in 2004, and the Pension Reform Act in 2014. So to be able to access this capital, you have to be a compliant entity. So we've had cases where state governments have tried to raise bonds, and because they had not been remitting pensions for their staff, not proceed, because if you can't get some of these funds to invest in your product, your security, when you issue it, you lose a significant portion of cash on the table. So you find a situation where most of them will quickly go and, you know, fix their house, make sure that they remit up to date and get a clearance from PENCOM before they proceed with their transaction. Next slide, please. Okay, so the regulatory philosophy of the SEC and generally in capital market transactions. In simple terms, the reason underpinning the regulation of capital markets by the SEC arises from the fact that regulators understand that investors should have sufficient access to information from companies issuing securities to enable them make informed investment decisions. Because retail and institutional investors have different capabilities to process information, assess investment risks, and sustain financial losses, more protection is given to retail investors to prevent inadequate disclosure. The SEC not only seeks to protect the investor and promote transparency and ethical conduct, but it also works to promote market stability. Next slide, please. So we just run a quick run through of the regulations. You have the Investment and Securities Act 2007, the Companies and Allied Matters Act 2020, the Trustee Investments Act, the Money Laundering Prohibition Act 2004, the Central Bank of Nigeria Act, the Foreign Exchange Monitoring and Miscellaneous Provisions Act, the Bank, the BOFIA, the FCC Act, and the Pension Reform Act, as previously mentioned. Next slide, please. We'll have to run through some of this so that we get to the meat. Next slide, please. Can you hear me? Okay, thank you. So registration with the SEC. To ensure that only fit persons are involved in the market and issuance of securities, you must be registered with the SEC. So for the companies, for example, if you're a private company and you intend to issue securities, of course, the next stage would be you want to convert to public. And then once you convert to public, you get under the purview of the SEC, because all public companies, whether listed or unlisted, you have to file returns to the SEC. The capital market operators also have to register, including lawyers who are referred to as consultants. So you need to be registered. And then in those law firms, well, you will have certain individuals referred to as sponsored individuals, like in other capital market operators. You have to be registered. I think there's about a 5-year experience requirement. So you then go through the SEC process. You read the available material. They want to confirm that you're conversant with the SEC rules, with the ISA, and with other regulations like the anti-money laundering regulations and everything, so that you're able to discharge your duties properly. And then when you write the exams and you pass, you go through an interview stage where you're then interviewed orally, and then you're certified as a sponsored individual. Of course, if you're moving from your firm to another firm or to another capital market operator, you're also supposed to notify the SEC, and you're able to transfer your registration. Even though it was sponsored by one entity, you can transfer it to another entity within a certain period. So the SEC carries out its duties of monitoring and surveillance to discover breaches of rules, maintain ethical conduct, ensure transparency, and promote confidence. You agree with me that the nature of the market, the quantum of cash and investments involved, only people, fit and proper people and companies are supposed to be involved. So if the SEC gets a whiff of untoward behavior, unethical conduct, then such persons will be penalized, because once the citizenry and investing public don't have confidence in the market, it's going to affect the market as a whole. People will not want to invest or purchase securities because they believe their securities are not secure. So everything works together as a whole. Next slide, please. Okay, so inspection of returns filed, investigations. The SEC also carries out enforcement actions, like I implied before. The SROs are involved, the trade groups, the APC of the SEC, the Investment and Securities Tribunal. So this could range from warning, suspension of the operator, withdrawal of registration license, you can be blacklisted, monetary fines, order of restitution and disgorgement of illegal profits, cancellation of transactions, and recommendation for indictment by professional bodies and criminal prosecution. Of course, in the last few years, we've had some individuals banned from holding directorships for up to 10 years in any capital market institution. So these are very serious offenses. Please proceed. Next slide. So dispute resolution with capital markets. So I'm just going to gloss over this because I don't do dispute resolution, but as a capital market lawyer, you also have to understand how this works. And usually when we have such disputes, we have a combined team where members of the corporate team and the dispute team form a team to appear in the matter and give the client the best representation. So you have mediation via the all parties meeting, which is called an APM. So the SEC or any other regulator can call this meeting after engaging with you, maybe writing, because sometimes it could be a client that reports you, it could be a shareholder reporting a registrar, It could be a shareholder reporting a company. It could be another capital market operator reporting another. So if you look at the ISA, you see the different breakdown. So you have the complaint management framework of the individual SROs. You have the APC of the SEC, which is the Administrative Proceedings Committee. You can also have, in spite of all this, you can also have a negotiated settlement, which will be the outcome of any of the previous three mechanisms. And you also have access to the Investment and Securities Tribunal. Of course, as mentioned, the SROs also have their own dispute resolution mechanisms. And you also have the whistleblowing provisions under the ISA. So even in companies and in end capital market operators, staff, employees, and anybody involved in the process can take advantage of this whistleblowing by reporting to the SEC. And companies are also required to have whistleblowing policies internally so that their staff can be aware that they can take advantage of this. Next slide, please. Yes, so like I said, employees of capital market operators or public companies have an obligation to disclose failure to comply with legal obligations or criminal acts. However, disclosure must be in good faith. How to measure that? So after class reading, you have to become friendly with your ISA 2007 and the consolidated rules and regulations of the SEC. So the SEC website has the consolidated rules, and as amendments are made, the SEC also uploads. So you have individual amendments before some of these are put together. So you also have to keep track of the regulations as they're issued, as proposed amendments are being shared with the public. You need to keep track so that you know what is coming and what's the way the SEC is thinking. If you're a member of the Capital Market Solicitors Association or your firm is on the email list, you will also receive some of these requests to take a look at draft rules or contribute to new regulation that is being proposed. Next slide, please. So make sure you read the provisions and understand them. Next slide. So let's start with public offerings. A public offering is an invitation to the public to buy the securities of an entity or unit of a collective investment scheme. It can be by subscription, it could be an offer for sale. The seller and buyers are investors in an offer for sale. So I'll just explain it this way. So if you have current shareholders in a company that is going public, they can have unissued shares that they want to offer to the public. That'll be an offer for subscription. But the shareholders can also use it as an opportunity to exit some of their holding. So that would be an offer for sale because they also have shares that have been issued that they want to sell. So it's also a good way when you have an initial public offering to also exit. But if you've been laboring in the company for a decade, then this is an opportunity to sell some of the shares you already hold aside the unissued shares that you're offering to the public. So an IPO is the first time the securities of the company are being offered to the public. It can be an offer for subscription or an offer for sale. In summary, next slide, please. How are we doing? I'm trying to, I don't want to waste our time. So who can make a public offering? Companies are coming to the market for the first time, as we already said. Next slide. Next slide. This is a summary of, so public limited liability companies, state and local governments and their agencies. You're aware that Lagos State just closed a bond offering at the Sukuk. Happily, we're part of that program in addition to other firms as well. The federal government and its agencies. ISA 2007 exempts issuances by the federal government from SEC regulation, though secondary trading will be regulated by the SEC. The DMO, that's the Debt Management Office, clears issuances by the federal government. Collective investment schemes such as the unit trusts investment trusts and exchange traded funds, and supranationals. Next slide, please. So all these entities can make invitations to the public. Section 69(1) of the ISA, an invitation shall be deemed an invitation to the public if it is an offer or an invitation to make an offer, which is so published, advertised, or disseminated by newspaper, broadcasting, cinematograph, or any other means whatsoever. So a lot of that is why you hear that the SEC has reprimanded some organizations or some companies. You're on Facebook, people are marketing all these products to you that are not SEC registered. That is a crime because it's an invitation to the public. That's why they try to come to your DMs. They come to churches or religious organizations. They try to do it through one-on-one because they don't want to be caught by this provision. But by the time you're printing flyers and you're advertising all these products, and I don't want any of you in this room to fall victim to these guys, because I've heard of lawyers also participating in some of these schemes and then they're burnt. Young lawyers want to double their money. I know the economy is hard. So you start investing, they'll tell you bring 500 to become 1 million in 6 months. Please be careful. You're working hard. Try to invest in regulated securities that you're certain that you will get your fixed income return. It could be 10%, it could be 12%, or you don't want 35% every 3 months. These things are unrealistic, and it's because they are not responsible to anybody. They go into thin air and you can't find them. Probably sipping champagne somewhere in Mauritius with your money. So lawyers, let's beware. So once you circulate it among persons, whether selected as members or as the venture holders of the company, so that means the investment companies, when they also share this information to their own customers, so maybe they have access to the information of the bank, some of these related holdco entities, that's also an invitation that is deemed to be an invitation to the public. Any invitation to any one or more persons to acquire securities dealt in by Securities Exchange or Capital Trade Point, or in respect of which invitation states that an application has been made or shall be made. So you understand what this is saying. So some people will tell you that we're in the process of applying to the SEC for approval, or we're in the process of getting our approval. They are taught by this provision. Please go ahead. Next slide. So next slide. Okay. So the following methods of public offerings. You have the offer for subscription, you have the offer for sale, you have rights issue, bonus issues, debt to equity conversion, private placement by public companies and or entities. Who understands what a bonus issue is before I go past that? Anyone? Should we move on until the end of the class? Okay. So even if an existing company that is listed has issued shares, they might want to raise additional capital, but they do not necessarily want new shareholders. They will do a bonus issue. It means that they have this amount they want to raise, and then they approach their current shareholders based on a pro rata analysis of your current shareholding. You would get an offer to purchase those shares. They're bonus shares, but then you still have to pay for them. I hope I haven't mixed my rights and bonus. Anyway, we'll come back to that. For your right, the description I gave is actually more for the rights issue, where you get a pro rata of what your current holding is. And then you also have bonus shares that the company issues as well. Pardon me. So you have the debt to equity conversion. So for the debt to equity conversion, so you might have a loan in place, either by an external party or by a shareholder to the company, and then the shareholder wants to convert to equity, and this could be for a number of reasons. It could be due to FX issues. So we had a lot of clients that had received capital from their parent company, foreign-based companies. They had dollar-based transactions. But because of the scarcity of FX in the country, they could not repay these loans. So they had to convert those loans to equity. It meant that then they issued additional shares to those shareholders in the company. Of course, this means you also have to go to the SEC to clear it. And the CBN will also be involved because the CBN has to scrutinize some of these transactions because of arbitrage. They want to be certain that the interest you're paying on these loans are not way above the going rate in the market. So your documentation, your draft documentation has to go to the CBN and for clearance of no objection before you proceed with such a transaction. I just wanted to explain that. And then you have private placement by public companies and other entities. You have offer by introduction on the exchange. You have debenture loan stock. You have state and local government bonds. Of course, you have corporate bonds as well. And you have the sukuk, which is a non-interest security under the Islamic issuances. Next slide, please. So benefits of going public. I think we've alluded to that earlier on, but seeking listing and its liquidity benefits, to access capital for project financing, asset acquisitions or M&As, debt financing or refinancing, to improve compliance with good corporate governance principles and attract institutional investors. So, you know, most of these exchanges will ask you to provide certain information periodically. You have to file returns. You need to have certain people on your board. You need to have non-executive directors. You need to have independent non-execs. So this shows that you have a higher level of compliance with good corporate governance principles when you're listed. To access the international capital markets, to privatize government enterprises, and to diversify the shareholder base. Next slide, please. So, of course, the offering process, conversion to public company, if a private company first, and you also have to amend the constitutional documents of the company. This is where lawyers come in. Of course, most of the time, the financial people are already at the table when the companies are considering their financial needs and the options available to them. So by the time they take this decision, they bring the lawyers in. That's why we encourage lawyers now to be more dynamic, creative. Once you're advising a client, you ask about their financial health, their business needs. You can be the deal maker by being the one to now tell them, oh, let me introduce you to a financial or investment house. They might be able to work on this. We have ideas around how you can access capital. And then that means that you're in the room early on and you're able to influence either your appointment or the transaction or even be part of the process, at whatever level. So there'll be the amendments of the constitutional documents to reflect the conversion to public. The restrictions in the shareholders will be removed and all other related points. Next slide, please. So you have parties to the issue. You have issuing houses. We mentioned them earlier. They're banks, merchant banks with a license to also participate in issuances, registrars, stockbrokers. You have trustees. They are the guardians of these funds. They watch out for the rights of the investors. For bonds transactions, they ensure that the payments are not disrupted and that the funds are properly safeguarded and ring-fenced. You have the solicitors to the issue. You have the solicitors to the company. You also have solicitors to the trustee. So I put question marks here in red because due to the costs of issuances now, the SEC, the FMDQ, the exchange, they're all conscious about ensuring that coming to the market, issuers don't carry too many costs. And one of the things that they have flagged is having a solicitor to the trustee, because the rules and regulations do not expressly require it. On most transactions, they will flag it and say, you do not need to appoint a solicitor to the trustee. And most trustee entities anyway have lawyers in-house, and they're the ones that prepare their agreements. So for some transactions, the client would appoint you anyway, but a solicitor to the trustee will most likely not be named on the transaction documents going forward. We've seen one or two transactions since 2022 where the solicitor to the trustee as a title was removed from the printed transaction documents. Next slide, please. So you have reporting accountants as well, underwriters, you have auditors, you have credit rating agencies, you have receiving agents. Well, they're not necessarily a party, but they are useful to the success of the transaction. And you have the receiving banks as well. Next slide, please. So I'll just run through this quickly. The offering process, the role of the parties. The issuing house organizes all parties' meetings and directs the allocation of responsibilities of each of the parties, including the issuer. They collate relevant information, they provide guidance on pricing, they prepare the draft prospectus. And I'll say our market is a bit different. So in the UK, in the US, and some other economies, it is the lawyers that prepare the prospectus and the offering document, because it's seen as a legal document. If you go through a typical prospectus, you'll see all the disclosures, the reps and warranties, financial information, information on the issuer, the constitutional documents. Everything is in this document. Or in the way our market developed, the financial guys, I think, were at the forefront. So they've held on tightly to the documentation process. So every one of us, including the lawyers, send them information. Our legal opinion will be inserted in the document as well. So they're required to understand their function and be like a common denominator between all the parties. And for the underwriter, they provide insurance against risk or under subscription of securities. Like I noted in the previous page, it's not compulsory. Go ahead. Next slide, please. The stockbroker leads parties to the quotations committee meeting of the NSC, and they handle post-offer listing issues on behalf of the issuer. The registrar keeps the register of members, arranges general meetings on behalf of the company, distributes annual reports, and for offerings, they collect application forms, they prepare the allotment for successful applications, return surplus monies. So once a transaction is concluded, well, almost concluded, once it has closed in the market, they will put together all the allotments received. Some will have errors, they will be discounted, they will not be accepted. All those that have been accepted, there will be an allotment proposal that will be forwarded to the SEC for approval. It is on that basis that those that subscribe will now be credited with their securities. The CSCS credits the accounts of investors with securities after the basis of allotment is approved. Next slide, please. You also have receiving agents. They distribute offer applications and they receive completed applications with subscription monies on behalf of the issuer. The receiving bank keeps the proceeds of the offer in a dedicated account until allotment is cleared. The rating agency assesses the creditworthiness of the issuer and assigns the applicable rating, which would be investors classify the quality of assets and assess the issuer's ability to repay. Rating symbols which indicate the likelihood of entities meeting obligations are also allocated. Next slide, please. So you have the auditors. are the retained auditors of the entity. They are responsible for auditing the financial statements of the issuer. The reporting accountants give a report on the audited financial statements of the issuer. The trustee has a critical role. They protect the interests of bondholders and investors. The solicitors ensure that the issue complies with all regulatory requirements with respect to the type of offer, documentary, and disclosure requirements. Next slide, please. Okay. So the solicitors should offer represent the interest of the investing public. So you have solicitors to the offer, which is the offer itself. So when you have solicitors to the company, which could be called solicitor to the issuer, and solicitors to the offer could also be referred to as solicitors to the issue. So you have the transaction as a whole. You have a solicitor that is the solicitor to that issue. And then you have a solicitor that is a solicitor to the issuer or the company that is issuing the security. So if you're the solicitor to the issuer or the company, you liaise with the board, the company secretary to provide all required documentation. You review the documents and ensure that all legal documents that will be required by the regulators and the solicitors to the offer are available. So you are expected to have started working with the company or the issuer in advance of even the all parties meeting or the first meeting on the transaction, so that when the solicitor to the offer approaches the company or the issuer to say, we need XYZ to review, because you have to carry out a due diligence to review all this documentation to ensure that the investing public will receive all the appropriate disclosures and information available. So the solicitors to the offer or issue draft transaction documents and ensure that the prospectus and other statutory documents are in compliance with the law. As previously mentioned, the solicitors to the trustee prepares the trust deed in compliance with the requirements of the set rule, but now their role has been flagged. Next slide, please. Okay, so you have the all parties meetings. Very few transactions now have physical all parties meetings, but in the past, you would have a day when everybody will be in the same room. The issuer would address you, tell you about the needs and the plans for this offering, and get all parties on board. Just like revving you up to say, we're coming to the market, we want everybody to be on board, we are counting on you to help us deliver a successful issuance. It is usually after such meetings or like about the same day that you get your appointment letters. But these days, we also have virtual all parties meetings where everybody is on the call, and then you get the same invitation and call to action. So the issuer is expected to disclose all information that is material. They determine the pricing method, whether through book build or fixed price. A book building method is a price determination process within the range indicated by interested investors. These are usually high net worth individuals and institutional investors like the investment firms and banks. The final offer price is then set by the issuer at the end of the book building period. You also have the shelf registration, which allows the issuer to file a program of offering with the SEC for the same security over a period. Preparation of draft transaction documents, trust deeds, reporting accountant reports, underwriting agreements. The lawyers give a report on contingent liability from claims and litigations and material contracts. We'll discuss this some more when we look at the due diligence process. You also have the credit rating, and you have audited financial statements, usually for 5 years. Less it's an offering or a listing on the alternative markets, which and the NASD, which require lesser period for companies with shorter financial history. So the latest must not be more than 9 months for PLCs and 12 months for state government bonds. Yes. And I just want to give a quick note on the audited financial statements. You would think that this is not a legal issue, that is a financial issue that the company should deal with. But because it really affects the transaction and it can stall a transaction, where on a bond transaction that has been stalled because the accounts became stale. So the word stale is used because if an account, the account you are presenting is more than 9 months old, it means that the market and the potential investors don't have your current financial information. So if you want to issue securities in January, or you start the process in January 2023, for example, you will probably not have your 2022 audited financial statement because the year just ended in 31st December 2022. The SEC would allow you bring your 2021 accounts and add management accounts for that period. But once you get in towards the middle of 2023, or let's say March, April, you will not be able to rely on 2021 accounts again and management accounts. You need to bring your 2022 accounts because the market requires up-to-date information. So you see companies or issuers rushing to ensure that their accounts don't become stale. But due to unseen circumstances, this can happen, and it means that the whole transaction halts until you have up-to-date accounts that can be accepted by the regulator. Next slide, please. So if you have a client, you also have to monitor that. So features of bonds. Fixed rates, you have fixed rates, which is a fixed coupon payment throughout the life of the bond. You have a floating rate. That means that the coupon rate is tied to a benchmark rate, such as treasury bills or the monetary policy rates set by the CBN, which carries variable interest rates. You also have convertible bonds. It means that it can be converted to equities of the company at a later date. You have non-convertible. It means it cannot be converted to the shares of the issuing company. People desire different types of bonds for different reasons. Someone else will go for a convertible bond because their real aim is to get into the company and hold its shares. So people don't want to be burdened by holding shares, so they want a non-convertible bond. You have secured bonds, which are backed by specific assets of the company to meet bond obligations in case of default. You have callable bonds. They can be redeemed before the maturity date. That means you can make a call to redeem it. Portable bond, it allows the investors to demand for early redemption of the bond. So the issuer can call it, and the bondholder can also put it and make a call for redemption. You have the zero coupon bonds. These bonds do not pay periodic interest, but they are sold at a deep discount. So I'll give an example. Let's say the bond is should be sold to you at 1,000 naira at 15% interest rate payable annually for 7 years. It means that every year you get 150 naira paid on that bond. If it's quarterly, it means you get it quarterly. So at the end of the 7-year period, you would get your 1,000 naira back, which is your principal. And over the years, you would have received 150 naira times 7. So that's about, is our math score. So that's about 1,050 naira, yeah? So that means you have a total of 2,050. So you make money on it. But if it's a zero coupon bond, it means that if it's a 7-year bond, you will not get any interest over the period. And most likely it will be discounted because you ought to have earned a certain amount over a period. If they sell it for, let's say, 10%, if it's at 10%, the coupon rate, it means that over a 7-year period, you should have earned 700 naira. So when you are subscribing for that bond, it will be sold to you at 300 naira. So the zero coupon bond of 1,000 will be sold to subscribers at 300 naira. But at the end of the period, you will get 1,000 naira back. Do you understand that? I don't want to confuse you, but that's how it works. So bond with term maturity, the entire bond matures at the same day. Next slide, please. I hope I'm not running late. I think I'm dragging this. So you also have serial bonds, you have exchangeable bonds, you have the sukuk, which is an Islamic bond. It's a non-interest bearing bond. What you earn is a sort of a rental. We can't go into sukuks on this trading. It's sort of but you can participate in the activity for which the capital is required. So you're bearing the profit and the loss together. So what you see on any transaction as interest on the sukuk is not interest, is a rental income from your participation in the transaction, whether it's infrastructure or whether it's a business or whatever activity has been done. You also have bonds with guarantees. You have subnational bonds that are general bonds, obligation bonds. So the structure of the bond will include the size of the offer, the par value, the coupon rate that has been mentioned, the bond tenor, and the maturity date. Next slide, please. So we go to the prospectus. I think we refer to the prospectus throughout this and what it must conclude, what it must include. Of course, general and legal information on directors and the key team, the shareholding structure and key shareholders. So they will want confirmation of all this from the lawyers. You want the financial information of the offer. The prospectus must contain every material information. It must be accurate and complete, and it must not contain misstatements or be ambiguous. There are civil and criminal liabilities for false and misleading statements in the prospectus. Next slide. The offering process. So information required. You find all this in the rules. You have the certificates of incorporation showing PLC status, the MEMAT, the shareholders resolution approving the offering. You have the board resolution also. You have the corporate history, directors and management, the project feasibility study, corporate strategy, material agreements and contracts, claims and litigations, licenses, significant policy documents, major shareholders and their shareholding, the share capital history of the company, particulars of directors, major clients, customers, annual reports and audited accounts, the going concern determination by a reporting accountant. You already know there's an auditor involved in the transaction, but they're deemed to have been acting for the company. They might be, you still want a reporting accountant to come and give their own opinion on this. Current indebtedness of the business, the schedule of assets, pricing memorandum, the risk factors and mitigants, corporate governance practice of the entity and the structure, the corporate directory, and the declaration by the issuer of disclosure of all material facts in the offer documents. The next slide. Excuse me. You also have the consent of directors and other parties to be mentioned in the prospectus. So law firms, for example, and other capital market operators, you were required to issue our consent. It's like a one-pager where you just confirm that you hereby consent to the mention of your name, that's your firm's name, in the program trust deed. You have series of the issuances. You also have like a series 1 trust deed. You have a series 2 trust deed as you have your issuances. So if your bond, the program that you have registered, for example, with the SEC, the 100 billion bond, it doesn't mean that you issue the 100 billion once. You probably start with maybe 20 billion. So you have a program trust deed, and then you have a trust deed for series 1 of the issuance, which will be the 20 billion. You also have the ISPO for state bonds. You have, for state bonds, you also required to produce House of Assembly edict or resolution authorizing the bond. It has to be gazetted with the particulars of the bond. This is to ensure that executives don't just go borrowing without approval by the House. You also have the rating report. State government bonds have some requirements as well. The total loan outstanding, including the proposed loan, should not be more than 50% of the preceding year's actual revenue. You must have a state law authorizing flotation of the bond. There has to be a sinking fund to be funded fully from the consolidated revenue account of the state. You also have the irrevocable standing payment order. This is a letter that is issued by the Accountant General of the state to the Accountant General of the Federation, authorizing him or her to deduct at source the statutory allocation of the state should it default on meeting its bond. So this is like a repayment because the states, all states are entitled to some statutory allocation. So this ISPO is like another security mechanism so that they can have, the trustees can have access to those funds to make the repayments. Next slide, please. The details of the loan should be gazetted. The trustee manages the sinking fund account and shall receive a copy of the ISPO. The bond shall have a maximum maturity of 25 years. Most bonds issued are way below that. 5-year audited financials, which are the latest, must not be older than 12 months. You have the feasibility of the projects. You have the full prospectus. You also have a trust deed, underwriting agreement if issuer wants to underwrite it. You have the vending agreement. You have the letters of consent, mandate letter. Yes, and just all particulars of what is required. Next slide, please. So pre-listing, once the offer closes, applications are collated and an allotment proposal is submitted to the SEC for approval. The issue will be aborted if the offer does not meet the minimum sum that the directors of the company or the issuer has stated that they need to carry out the projects they must have listed for the offering. The issuer will submit the approved list allotment proposal and general undertaking and newspaper adverts of the allotment, and also a declaration of compliance briefing, and they must meet all post-issuance and listing reporting requirements of the SEC. And the SEC also conducts periodic inspections of the project for which funds were raised. So it's called as issue proceeds. You have to use it when you're going for the securities and entering the transaction. The issuer would have stated the projects, if it states infrastructure projects or other projects that they require these funds for. So they monitor the use and application of these proceeds to ensure that it is not diverted to other projects. Next slide, please. So listing on securities exchanges. You have the Nigerian Exchange Limited. They have the premium board, the main board, and the ASM. Of course, the premium board has stringent listing requirements and corporate governance standards. You also have listing on the FMDQ exchange. It used to be an OTC platform, but it's now a full exchange, and it's basically the largest exchange now in the country. You also have the NASD PLC exchange with their own requirements. So even if an equity is not listed, you can trade in it on the NASD platform. It helps to improve liquidity in the market because you can trade in unlisted companies. Next slide, please. So over-the-counter platforms, they trade in securities through broker-dealer networks instead of the centralized exchange like the NGX Limited. These are smaller companies that may not have a long financial history or meet the stringent disclosure requirements of a formal exchange. Like you said, we discussed the disclosures, material information. Some companies don't have that, but they require urgent. So some of these exchange platforms, if you have 2 years, 3 years financials, you're able to access capital, though a limited amount from some of these exchanges. Just to mention here that the FMDQ exchange is now a full-fledged securities exchange. It is the largest exchange in Nigeria and has had a market turnover of over 500 billion US dollars in the last 9 years. So many people think the NGX is the largest, but FMDG is actually a big player. Next slide, please. So the offering process, the SEC limits the total cost of issue, as we highlighted earlier. Of course, there's been a downward trend in IPOs, initial public offerings, because for IPOs, you're buying shares of the company and you don't have an obligation to repay. That's in quotation. You are supposed to run the company properly, and if you're profitable, you declare dividends. But that's different from when you have a loan or a bond. These are obligations that you have undertaken to repay at a certain percentage at a particular time. So it's not exactly free money. So that is why the costs that are allowed for bonds and loan issuances, securities, are lower than for equities, because it's a burden on the company. It's something that has to be repaid before the shareholders can have access to dividends or other distributions. So the cost is expected to cover the financial advisory and all professional fees, marketing, regulatory charges, VAT, and other incidentals. Just a side note here that the Nigerian Exchange provides for a listing by introduction for companies that have had the required number of public shareholders with 25% of the paid-up share capital held by such shareholders. These companies can list by introduction without making a prior offer to the public. The securities must be registered by the SEC. Next slide, please. Am I rushing? Am I too fast? Restricted offers, rights issues, and private placements. So rights issues are offered only to existing shareholders of the company. A rights circular containing vital information about the securities and the issuer must be sent to all shareholders. Shareholders can exercise their rights in full, partially, or renounce their rights completely, or trade their rights on the exchange. Rights issues can be underwritten, but shareholders must waive their preemptive rights before the writing can be done. Private placements are offered only to identified investors and permitted by the SEC under conditions stated in the rule as well. Next slide, please. Before we conclude, I've tried to rush through the summary and the introductory aspects on the issuances, because I think the due diligence process is a very important part of our work. So whether it's a capital market transaction, a securities issuance, M&A, if it's an acquisition, if it's a private equity investment, as a lawyer, you'll be required to conduct due diligence. And it's not it's not a complicated process. It just means that, so I'll just give this summary, which I think captures it aptly. The term due diligence is used generally in the corporate finance context to refer to the process of investigating a company's business, legal and financial affairs in preparation for a possible transaction. In securities offerings, the due diligence investigation enables the underwriters to gain a clear understanding of the issuer and its business, to assess the risks associated with the proposed transaction, and perhaps most importantly, to confirm the statements made in the offering document in order to avoid liabilities under the securities laws based on incorrect, incomplete, or misleading disclosure. So this captures whether it's a securities issuance or other transaction. It just means that all the parties involved. So that's what the reporting accountant is doing. That's what the financial advisors are doing. That's what the legal people are doing. Everybody is ensuring that every information that is material is contained in the document. And the company itself and its directors will certify that there are no misstatements there and that they have disclosed everything that is required to be disclosed. Next slide, please. So when do you need due diligence? You need it in private equity investments, offering of shares, debt offerings, M&As, joint ventures, other financing transactions, or even good old corporate investigations, you'll be aware of alleged fraud in some companies. You might be called upon to come and investigate, and they'll tell you, so you have to drop your list. Next slide, please. You have to take control of the process and check certain information. Next slide, please. Okay, so why do you conduct a due diligence? Because most transactions involve substantial financial obligations. You also do it to determine the attractiveness and risks of a potential investment, as well as extract issues that will require resolution in order for the investigation to be brought to a successful conclusion. It is also necessary to determine the undisclosed risks which are attached to the transactions, as this may result in the transaction being aborted or affect the purchase price or terms of the agreement. Next slide. Next slide, please. So just to mention that in our experience, the negative information that you find is not necessarily an exit card, or it does not mean an end to the acquisition process or the issuance of the security. So these issues are usually addressed, like we mentioned, for discounted bonds. If there's a risk or there's a cash flow issue, you get a discount. You discount the value. You adjust the purchase transactions. You retain some funds that, or you put funds in escrow and say, when you meet this condition, when we get this information, when we get these documents that you say you're waiting for, then you will receive this percentage of the money. And you put indemnities, you did the representations or warranties. You may ensure that they are properly crafted in the document in a manner that provides additional comfort to the buyers or investors. Next slide. So the due diligence process involves appointment of the team. So in capital market transactions, once you're appointed in-house, your firm will put together a team to carry out this process. You must get clear and definite instructions. If it's an issue, you know what you're watching out for. You know your firm will have to issue a legal opinion. If it's a commercial paper, you know that there's no other firm that is looking at your work. You're probably going to be the only solicitor on the transaction. You have to give a legal opinion on this current status and going business concern of the company. You have to give a legal opinion on contingent liabilities. You have to look at confidentiality agreements. It is a data room. You have physical data rooms, and you also have virtual data rooms. You have to, the team needs to understand how each room works. You have a questionnaire and checklist. So each questionnaire is different. I've not put a sample checklist in this paper because it's different from case to case. You also have one-on-one interviews with management staff. You have investigative form of inquiry. Sometimes the information you have might be unavailable, that you require might be unavailable, or it might be deliberately hidden. You also have to cross-check some of this information against public registers. So even if a company gives you their form, well, those no longer apply with the way the CAC portal works now. But if you get a status report on the company and you have details from them, you need to go to the CAC and obtain some information. You have to conduct some searches to ensure that things have not changed since the material provided to you. Then you also have to issue your report or legal opinion as it is referred to. Next slide. So your report or legal opinion should contain an outline of the scope of the review, an analysis of the documentation and information reviewed, a list of information disclosed by investigations, limitations and disclaimers of liability, an executive summary which outlines legal issues and potential problems identified. So if you're appointed, if your firm is appointed to carry out a due diligence review or act on a money or capital market transaction, and a team is in place, unless it's a really small transaction, you will probably be a team member for this assignment. You might be given as a part of the documents to review, because if you have a large body of documents, you won't be able to do it alone in good time. Of course, sometimes you feel, oh, a uniform level of appraisal, but then you have to agree a document on how information is captured. You must have a template that everybody uses so that people don't capture information haphazardly and then you don't have the same thing. So your team must agree ahead on how this information will be reviewed, what you're looking for each information, each document reviewed, and ensure that each team member, once some people might be looking at the litigation, some people might be reviewing material contracts, somebody else is looking at constitutional documents, but then all your review material comes together to form one whole opinion or report. So everybody is pulling together towards getting the transaction to ensure it is successful. Next slide, please. So in legal due diligence, so we discussed due diligence generally, involves investigation, verification, and identification of the issues. Depending on your transaction, it will encompass a review of the documents, analysis of contracts and other agreements that are expected to be assumed upon completion, and confirm current status and consequences. It will also address threatened or existing litigation matters. So your company might be going to the market to raise 25 billion, and then you discover that somebody has sued them in the Niger Delta. Maybe it's an oil and gas company and has sued them for 5 billion. You have to ensure that that dispute is, even if it has not been filed in court, because you are addressing potential or existing claims. So you have to make sure that you look at the claim documents, you look at the defense of the company, you ensure that you capture anything, because if the suit is successful, it means that the company will be out of pocket of 5 billion and above, if there are other damages also. So you need to be able to make an estimate. And if it's a frivolous claim, you need to be able to review it and say, yes, even though the company has been sued for 5 billion, we have reviewed it. The specific damages in this matter are less than 1 million naira. This person has just asked for a ridiculous amount. The Nigerian courts would ordinarily not grant this kind of damages. The Nigerian courts have not granted higher than 50 million damages or 100 million. So in our own view, the estimated or contingent liability in this particular case is not more than XYZ amount. So you also have that discretion to be able to make an estimate based on what you have seen, based on your experience and understanding of the Nigerian judicial system. So with respect to contracts, you have to note an ability to assign and whether the transfer of ownership could trigger any unfavorable consequences. So this is talking to like an M&A, for example, because due diligence covers that and issuance. I didn't limit it to issuances alone. So if you're having like a merger, for example, or you're acquiring a company and there are contracts and you're looking at their material contracts, you're looking at their contracts, maybe software contracts or service contracts, you need to be able to spot whether any contract has provisions that say that, oh, you cannot transfer this contract to another party without the approval or consent of the other party. So you need to ensure that you note those and that the company does the appropriate thing by extracting that consent before you close on the transaction. Next slide, please. So like I mentioned, there's no one-size-fits-all list of documents for a successful due diligence process. So you identify what the client needs or the particular transaction needs. For issuances, there's already guidance in the rules on what you have to look at and what the company has to disclose in the issued document. So you have to prepare a comprehensive checklist and you customize as appropriate whenever you want to send a request. So you just don't send a general request asking for everything under the sun, and then they're looking at you and wondering, does this even apply? This is not applicable to our transaction. So each time you are sending out your list and request for documents, you have to scrutinize it and make sure that it's fit for purpose. Next slide, please. So there are challenges with the due diligence process, and you must be aware of this when you're carrying out due diligence on an issuance. You have information asymmetry, which I've referred to as incomplete information, or there are hidden liabilities. We've heard stories of oil and gas companies that are listed on the exchange, that some contracts were not disclosed during the process. And it was only after the listing had been concluded that some of their institutional investors discovered that maybe some of the directors or related parties to them had significant contracts with the company. And the investors would have taken a position if they had seen this material contract. So those that gave opinions or issued reports would be asked questions. Did you ask for it? If you ask for everything and they deliberately withheld it, then there will be sanctions against such people, whether management or the directors involved. External information corroborates information provided by the company, but sometimes even these sources of information are difficult to extract information from. You might want to conduct a search on an asset, maybe a real estate property, and you go to the land registry and they tell you that, oh, we are digitizing our process. They have a post on the door saying no searches until the next 2 weeks. Those are challenges. So how do you then report on the status of that when you don't have corroborating evidence from it? It means that your report is going to be riddled with qualifications. You have to say the company, we asked for this and we were giving this document, however, we were unable to confirm. Because if you go ahead and confirm based on only what you received, it might come back to bite you. So as lawyers, of course, I say we don't want an opinion that is riddled with qualification, because it now affects the quality of that report. Because people say you qualified everything, so what exactly are you telling us? What should we do? So you try your best to ensure that you go around these challenges. Next slide, please. But you have to be aware of them. So if third-party confirmations fail, a party with the intent to mislead or deceive by withholding critical information will effectively put the acquirer or investor at risk of liabilities or obligations not envisaged. You also have to look at the scope of your review. The scope of due diligence should be adapted to the context of the transaction to ensure that the investigation matches the investor's interests or buyer's interest in the deal, and to complete within the specified time. Next slide. Also, timing. Time constraints affect the thoroughness of investigations, with our peculiar challenges. Delay at third-party registries or agencies may lead to court. So you have to be aware of it. Once you start the process, you need to, and that's why if you have constraints regarding team members, maybe you don't have enough people. Sometimes some firms, you see that they take on another firm to join them to enable them to discharge their duties properly. So you have to have somebody already at checking different places instead of completing one process before you start the other. Because if the issuer, for example, wants to close the deal in 2 months or in 3 months, you cannot be the party that is dragging the transaction down or not completing it in due time. You'll probably not make the next transaction. And virtual data rooms. So virtual data rooms are different from physical data rooms. And I've always told people that they are risk, they pose more risk to the professional if you don't do your job well. For physical data rooms, you might go to the location of the issuer. If it's a company, they'll dedicate a physical data room and they'll bring documents into that room. And then you and the team members come to that room to review the document. So it's quite easy to say they have brought X files. There's a piece of paper where you say, we saw this, and everybody signs against it that these documents were brought and reviewed. You don't take anything out. You're allowed to photocopy some. You do your review, you make your notes, you leave the documents there, and you leave. Everybody signs against what was issued and what was seen. It's different from virtual data rooms. You know AI and how everything works. Your movement is tracked across the data room as you're reviewing documents. You can be asleep and another document has been uploaded to the data room. When you're in the data room, you have to make sure that you open every document that you're supposed to see. If you open a document, you have to scroll. Sometimes some people will review a document, they think it's one page. It turns out that another document was scanned along with it. If you complete your report and you claim that you didn't see something, and then a liability arises in future, it might be that the document was there, but you failed to look at it. Your team member was lazy. Maybe you had been reviewing 100-page documents and you got tired and you missed just one. That one will be critical. But the thing is, you cannot deny it because the virtual data room and the way the AI tracks it will show you that this document was posted at 2 p.m. on 26th of May 2023, and you entered the data room 2 days later. You were in the data room for maybe 10 hours. You were in data room the next day. You were in data room several days after. So it is your fault for not seeing that document. They will claim that we uploaded it, the document is there, and they can't tamper with it because this is an electronic data room. So the lawyer has to be more watchful when you are in a virtual data room. And the virtual data room is also supposed to help you with speed, to enable you to quickly go through. You don't have to leave your office. You don't have to resume somewhere. You don't have to pause through documents. You can download some, you can print some. So it's supposed to make your life easier, but it's not supposed to make the life of the acquirer or the investors difficult when you now miss documents or you fail to note some critical documents to the transaction. Just wanted to highlight that for the VDR. Next slide, please. So the process of carrying out due diligence is supposed to be a sort of insurance and risk transfer for the parties involved in the transaction. So the client aims to outsource its risk. So a report riddled with qualifications on basic information, it raises more questions than confidence in the accuracy of the opinion submitted. In fact, some transactions do not proceed. Issuing houses for any issuance, for example, into the Nigerian capital market, if you put too many qualifications, they're going to send it back to you and say, so it's just the issue, you cannot accept this. The SEC will flag this and the transaction will not proceed. And then you have to say, then the issuer needs to correct these things. We need more information. Because otherwise, if we don't see something, we can't claim we saw it. We cannot change the status of what we have seen. But then it's a collaborative effort. So it's not that you're going to be gung-ho and say, no. You will have to work with them to ensure and give them information that you require that will make your reports more palatable to the regulator. Next slide, please. So this is the stated duties of a legal practitioner in security issuances. Well, just a few that I think are critical. You carry out due diligence to ensure that all information material to a transaction are disclosed in the transaction documents. You advise on the legal structure of the transaction and legal risks associated with it. You negotiate, draft, and review all legal documentations required for a transaction, including but not limited to the prospectus, offer documents. You advise parties on disclosure, you advise on compliance, and you certify or obtain certification of compliance with all statutory requirements by the issuer and other parties to a transaction. You make all statutory filings and provide confirmation, that's a legal opinion, as to enforceability and effectiveness of the transaction documents. Next slide. Full disclosure by the issuer. So yes, the lawyer has a role to play, But luckily for us in our market, the issuer is actually the one with the responsibility for full disclosures. So they have to make disclosures of the financial position and prospects of the issuer, the rights, if any, the merits of investing. The issuer must make a sworn declaration, that's the directors of the issuer, that it has fully disclosed all material facts in the offer document. And the declaration shall be signed by the Chief Executive Officer, the Company Secretary, and the Chief Financial Officer of the issuer. Next slide. Is that a question? Okay, I'll go on. So
yes,
the commission, all right, the commission itself, it absorbs itself of liability and the rules, because people can sue the SEC for saying you approved this security, see what had happened. So expressly, they require that on the face of the prospectus, that the following is stated on the face of each prospectus, very, very boldly written, that the directors of the issuer collectively and individually accept full responsibility for the accuracy of the information given, and confirm, having made reasonable inquiries, that to the best of their knowledge and belief, there are no material facts, the omission of which would make any statement contained herein misleading. The Commission has approved the issue, offer, or invitation in respect of a public offering, and the approval shall not be taken to indicate that the Commission recommends the public offering. The Commission shall not be liable for any non-disclosure on the part of the company, and takes no responsibility for the contents of this document, makes no representation as to its accuracy or completeness, and expressly disclaims any liability whatsoever arising from reliance upon the whole or any part of the contents of the prospectus. You can see this clearly. So the whole box stops with the directors of the issuer and its officers. They are the one making these disclosures, and they are the ones that will be responsible for any material misstatements. Next slide, please. So just to reiterate that the SEC operates a disclosure-based regulatory approach. The issuers are required to disclose material information. The sanctions regime for contraventions largely apply to issuers and financial advisors who are liable for untrue statements or misstatements. Pursuant to the general principles with respect to due diligence investigation, legal practitioners are only obliged to provide a comprehensive opinion only within the limits of the specific question for the transaction. So, but this doesn't mean that we shouldn't take care in rendering that opinion. This was just stated to let you know that yes, you can do your work, you can give your opinion, but largely it is the issuer that will be held liable for misstatements. Ours is to ensure that all the disclosures to the best of our ability, and once they're giving us those declarations and representations that they have given, then our own obligation has ended. Next slide, please. So recommendations on due diligence. Just to summarize again, when you have to carry out this review, you need to agree the scope of due diligence investigation. You have to expressly indicate to the target of the issuer that contracts and agreements should include all commitments or arrangements in final form or under negotiation. That means your firm would make that request, and it is in response to that request that you receive documents. So you don't want a situation where you failed to include a request, and then later, if something happens, they say, well, you didn't ask us. We thought we had given you all that you required. So you make sure that you make your requests very express. You coordinate closely with other professionals involved in the transaction to avoid delays and mitigate risks of misunderstanding of timing and other important details. Consideration for confidentiality and data privacy during the process and in the report. So you'll find that a lot of issuances that are also sensitive you have to, I know that I don't want to sound, but we have all these chats going on in WhatsApp groups. We have your friends, your close friends, that you're so excited to tell that you're on a transaction. If a transaction, information about a potential transaction comes to the market prematurely, it can affect the success of that transaction. So when you're on these transactions, you also have to understand the confidentiality of the process, the timing an offering comes to the market can affect it. If there are other information in the market and it comes prematurely, some people might even go and take positions in the company. So let's say it's a listed company, for example, and you have been engaged and discussions are ongoing. You can't go and start discussing it with your uncle, somebody somewhere, because some people can start buying up shares or taking or dumping. You don't want, they're price sensitive information once you are engaged in a transaction of this nature. So you have to respect your clients. And even when you're responding to requests for research by some of these legal, what do we call them, like Legal 500 and some of all these other research lists for lawyers, some of them you can't even report such a transaction because it's still confidential at that point. When it's concluded, then you're able to report that you participated on it. Also, you have to insert appropriate qualifications in the report, as we've mentioned, so that you limit your firm's liability. It's also advisable for firms to have professional indemnity insurance in place. So even if you've covered your back and you've ensured that you did your best on a transaction, it doesn't mean that you won't be sued. And being sued doesn't mean that you'll necessarily win. But if you have your indemnity in place, you can cover some of your costs to defend yourself in the case of such an action. Next slide, please. So the SOX issues, I'm just going to go through some of these because we've discussed them at length: the data room and the attention required when you're in the data room, whether physical or virtual. The solicitor's opinion on contingent liability from litigation and claims is very important. If it's a state government, if it's a PLC, you just have to ensure that you extract as much as possible information from them. Some of them will tell you they can't find the files for some cases. You need to insist on receiving them. You need to copy the appropriate people. If it's a state government, you have to get conversant with the Ministry of Justice. You need to give them advance notice so that you get the files, because especially post-COVID now, you have people working some days remotely. Some people will take files home when they go to court, because they're the ones going the next time it has been adjourned. It's just going to be in the boots of their vehicles. So you have to insist on the supervisors in those places to say, we want to see this. Some people will just tell you, contact the lawyer handling it. Let them give you a summary. The lawyer will give you a summary. But if you don't actually see the claims and the responses, your opinion will be based on another firm's opinion, and that firm doesn't have the responsibility that you have on the transaction. So your duty is to ensure that you see as much as possible. And you need to also prepare a list of what you saw and add it as an annexure to your report as much as possible. So you have a full report, and you will have the summary report that will be in the transaction document. So your full report should contain all what you saw. Of course, the appropriate representations of warranties will be in the offer documents. On the termination clause, this is very important, because when you're signing your terms of engagement in such transactions now, your firm has to be conscious about termination, because what we've seen in capital market transactions is that everybody is hopeful and optimistic about having a good transaction, successful issuance, but half the time, issuances don't get to the finish line. And you will see that as a law firm, you have worked on this transaction and then you don't get paid, because everybody is supposed to get paid from a portion of the issuance. But the financial advisors are very smart. Typically, they would have an advisory contract in place, because they started working before the all parties meeting. So whether or not the transaction is successful, they get paid for the work they've done so far. So you have to ensure that in your terms, you put like a stage in the terms of engagement to say, if we've provided services and we've carried out this work up to this stage and before the SEC approval, we'll be entitled to a percentage of our fees. If we have submitted documents to the SEC and then the transaction is eventually not approved, we will be entitled to XYZ. If the transaction is not approved, then everybody walks away at this point. But you try to get them to commit to, otherwise you will see that you work on a transaction for 4 months, 6 months, and then the transaction is postponed indefinitely. Sometimes they might come up again in a year's time when the company is in a stronger position financially and regarding documentation. You might be called upon to work on the transaction, or things might have changed in the company or in the government, and a totally different law firm will replace you on that transaction. So you end up not getting paid. So you have to look at your termination clause in your contracts or appointment letters with issuers on capital market transactions. And also, you have to pay attention to dispute resolution clauses in contracts between the issuer and the joint or multiple advisors. So as solicitors to the issue, you'll be looking at vending agreements. I'm glad you already took the session on the arbitration clause because most contracts will have arbitration clauses in between the issuer and parties. So most times you have joint issuing houses, you have the lead issuing house, and most documents will have a dispute resolution clause that says when there's a dispute between the issuer and the joint issuing houses, the issuer will appoint an arbitrator, the joint issuing houses will appoint an arbitrator, and both arbitrators would appoint the lead arbitrator or something of the sort. But you have to be careful because in some cases, where you have multiple parties, even if you have joint solicitors, for example, it might just be one party or a set of parties between those joint parties that has a dispute with the issuer, or the issuer has a dispute. So you need to have an arbitration clause that also envisages a situation where it is not all the joint parties that would have a dispute at the same time. So you need to have a second layer that says, if only XYZ have a dispute, then this is how the appointment will take place. Otherwise, your document is not fit for purpose. And they'll say, who are the lawyers that drafted this agreement? Now we're at a stalemate, we don't know how to appoint. And lastly, emotional intelligence is required in the process because we are all different. You have different law firms, you have different advisors, you have different firm styles in your documentation, in your drafting, in your process. And so everybody needs to understand the dynamics of the transaction. You have to understand the timing. You have to know those that are calling the shots. You have to work well together with your colleagues in your firm, your colleagues in other firms, and the transaction parties to ensure that you don't have ego affecting progress. Because if your client cannot achieve the transaction as I went you, then everybody's just there wasting their time. Everybody will be told to go home. And any party that is found to have delayed the process of making it difficult will be let go of. And this is a small market. Word of mouth. Some people just say, people in that firm, they are difficult to work with. Let's work with these other people. The last transaction we worked on, they were very fast. So that's a very important point to know. Next slide, please. So this is Q&A. I don't know if you have questions. I've tried to run through. I'm sorry, Ade. I'm 10 minutes over, I think.
No, it's totally fine, ma. And then we have in the room. It's the person has been waiting, but we decided to wait to the Q&A session before we could ask him.
Okay.
Good morning, Ma. Thank you for your presentation. It's been awesome. I appreciate the regulatory to practice model you've adopted, and it's been Okay, I said thank you for your presentation. Can you hear me now?
Yes, I can.
Okay, I said I appreciate the regulatory to practice model we've adopted, and it's been very nice. I want to draw you back to when you were talking about types of is it equity equity investments or something like that, where you mentioned the and bonus issue and all that. Before then, you mentioned the IPO, that's the initial public offering, right? And
yes.
You mentioned bonus issue as well, rights issue. Now, I'm considering the current state of the Companies and Allied Matters Act, where parties or companies rather are no longer allowed to have unissued shares.
Unissued shares, yes.
My understanding, and correct me if I'm wrong, is that in IPOs and bonus issues and rights issues as such, the issuance are unissued shares, really. So how would this practice of IPOs or bonus shares or bonus issues or rights issues, how will it proceed, like practically right now, in this current state of not having unissued shares by companies?
Okay. Is that all?
Yes, that's all.
Okay, so basically, I would say nothing has changed really for the larger companies or companies intending to issue capital, because in most cases they would usually need to increase their share capital. So anytime you want to issue or have an IPO, such companies will just go to their shareholders, obtain approvals, and file the documents at the CSE, increasing the capital. And in the resolution, you would already have saying that hereby approves the increase of the share capital from X to Y to enable the company issue shares of up to and then it authorizes the directors and other officers to do all that is required to get the issuance done, and appoints professional parties to issue, whether it's a bond or whether it's an IPO. And so the CSE sees that, and once you increase that and then you go to the process of the issuance, there's no problem. Because most of the time, when we do these issuances, the companies don't even have adequate shares for which they need to make the issuance. So it's just going to be the same process. It's only smaller entities that usually want to, keep those shares because they're good. Most of the startups, we've had to tell them, in compliance, just to allocate it. They are holding the shares so that when they get an investor, they can just allocate and sell directly instead of not having anything. But now you have to just issue all, and when you require it, you go and increase. So you increase just what you need. You ensure that you don't keep any unissued shares. I think that's how it will be done going forward. I don't know if that's clear.
Is that clear? Yes, that is clear. We have another person with another question.
Sorry, it's still on the unissued shares. The December 31 deadline of last year, is this sacrosanct or it could still be reopened? Because there are some companies that have not really met that deadline. Is that the end?
So this has become karma. I wish my karma people, my CSE people, my colleagues that deal on it on a regular basis. But what we've done, and we've had to advise clients on this, is that the 31st December 2022 date was to allow people issue their unissued shares without penalty. Because as soon as KAMA 2020 came and the regulations were issued to say you can no longer do this, it became like, I don't want to use the word unlawful, but then you were not supposed to hold them. But then they gave that period of grace so that you can issue it. What we've advised clients and what we've been told at the CSE informally is that if you have unissued shares as at 1st of January 2023, which you still intend to issue, because the CAC is deeming them to have been, like, they've gone poof, they no longer exist, to see and submit an application saying that you want to issue those shares, but then they are going to calculate the penalty at the daily rate from 1st January 2023 to whenever. And the confusion is, are they going to be calculating it from when the regulation was issued, because there was a grace period up until December last year, or is it going to be from January 1st? I think that is where we did not have clarity. But if you still want to issue those shares, then you have to do an opportunity cost to say, this is the penalty that we'll be paying to issue these unissued shares. Is it worth it, or should we just forego it and register new shares? That increase the capital back to what you need. So if the penalties are higher, then it doesn't make sense. You just go and do your additional capital, new capital. Yeah. I don't know if that's clear or that's
very
helpful.
clear. Thank you very much.
Okay.
Thank you.
All right.
Yes, we have another question. I want to pass the mic to the person.
Good morning, everyone. I would like to appreciate you for the robust knowledge you shared with us. The first person, my colleague that spoke first regarding the unusual share, I really love the insightful response that you gave, Ma, and that has prompted me to ask this question. In a situation where a private company would like to expand their reservation, aside increasing their share capital, would we advise that such company go through private placement?
Okay.
Yeah, that's my question, Ma.
So, okay, so you're asking whether it's easier to do a private placement than a full offering. Is that what you're asking?
Yes, ma'am. Aside increase of issued increased share capital, like increasing their share capital.
No, but if you do a private placement, you still need to give them shares in your company. So if you don't have unissued shares, which shares will you give them if you don't increase your capital? Maybe we are mixing the issues. Do you understand my question?
Yes, ma'am, I'm following.
So if you want to do a private placement, it just means that you're saying you're not advertising to the public and you just want to target a few people that you invest through an investment firm. But at the end of the day, they are going to look at your documents the same way you are going to submit it to SEC. The high net worth individuals you are targeting, they will look at your financials, they will do evaluation, because it's not that you tell them that your share is 50 naira per share, 50 kobo shares, and they will just accept it. Pardon. Their advisors are going to look at your history, they're going to look at your business plan and your forecast, and they're going to come back and say, no, we can't buy it at 50, we want to buy it at 20 naira, or we want to buy it at 25. But ultimately, you will still need to allocate shares to them in your company. So if you don't have unissued shares, you have to increase. However, some companies might decide that they want to, since they're not listed, they might decide that they want to restructure their shares. So if you have shares, you have 1 million shares, they might want to break it down further and say that those 1 million shares, instead of being 1 naira each, they are now 50 kobo each. It means that your shares will become automatically 2 million, and you can restructure and reallocate shares to your shareholders, so that you now have room, without going to CAC to increase shares, you now have room to now issue shares to new people because you have now redesignated your shares as 50 kobo shares instead of 1 naira shares. Do you understand that? So you've created more numbers. No, I can't hear her.
Oh, I'm sorry, Ma. We actually lost you for a few seconds when the light went up, about 30 seconds. But we are back now.
Okay, so
we heard the last.
What did you hear?
Yes, we heard your last statements for the last 5 seconds, 5 to 10 seconds.
Okay, so what I said is that if you're offering shares to via a private placement, the people you are targeting will also be reviewing your documentation. They will also challenge you on the valuation you've placed on your shares, and they can make counter offers on what they want to pay. But all in all, you will have to issue them shares when they accept your offer at whatever price. And if you don't have unissued shares, you will have to go to the CAC to increase your share capital so that you have new shares to allot. But then I qualify that by saying that in some cases, some people choose. Can you hear me?
Yes, Ma, we can hear you clearly.
Yes, so in some cases, some people choose to restructure their shares. So if, for example, your share capital is 1 million naira share capital of 1 naira shares each, it means you have 1 million shares. Some companies will go and take a resolution that now redesignates those shares as 50 kobo shares. It means that the 1 million share capital will give you a total of 2 million shares of 50 kobo each. And then they reallocate shares to shareholders. That means they now have additional shares that they can allot to other people. And it means that they would have taken this process on before approaching those people for a private placement or issuance. I don't know if that's clear. So that is an option of breaking down your shares into smaller units, so you don't have to approach the CAC.
All right.
It's an option. Yeah.
Yes, she said that is fine. So one more question from here, then we'll come online to ask the online participants.
Sorry to maybe bother you again, but from what I've seen or what I've experienced and stuff, when people do financing, for instance, going to the capital market for bonds or commercial papers and stuff, it's for particular purposes, maybe to pursue an undertaking or a project or whatsoever.
Definitely.
And so let's say a situation is in a program, not a vanilla bond. Let's say a bond situation is in a program for infrastructure. For example, like the example of the Sukuk that was done, but in another situation, let's say not a Sukuk, just a regular bond.
A regular bond, yeah.
Yes, in a program. And the program size is like 100 billion naira for the purpose of maybe infrastructure, maybe like a road project. And after the first series, the second series, the third series, and the fourth series, they discovered that to pursue that particular project, maybe their prior estimation that 100 billion will cover it it now turns out to be inadequate. And then there is a need to issue maybe just one more series, but issuing that series will be outside the program, right? Let's say they need to raise 25 billion more. Yeah.
And you have only 10 left.
And you have only 10 left in your program size. Now, other than and the whole transaction document, the vending agreement, the shelf prospectus and all that would have stated 100 billion, right?
Yes.
So other than now time is of the essence. That's important. The time is of the essence. So they need to do it ASAP. So other than amending and restating, which is the obvious thing, amending and restating the transaction documents and shelf prospectus and pricing supplement and all that to reflect the increase because of time at the FMDQ and SEC and all that, what other mode can they go through?
So are you saying if it's like a state bond, for example?
Yes.
Because if it's a corporate one, the process is easier. You can get your shareholders together and you quickly turn things around. But for state bonds, and I'll use a recent example, I think it's what you're saying is not impractical, but the SEC takes a position. If what you're doing is going to be outside the documents you have, and so if it was that you were appointing a new trustee or you were doing something, the SEC will be more amenable to you restating and doing those things. But if it's taking you outside that program, in our recent experience, I don't know, it could change tomorrow, the SEC will say, why don't you do just the amount you can do under this program and bring papers for a fresh program? And then under that fresh program, you can now do as much as you want. And I'll use the Lagos State Bond because the signing ceremony was this week and everything is out in the open. I don't know which program you worked on that brought this issue up. They had a 500 billion program, and then they wanted to do more outside it because what was left was not going to cover up to the 100 billion that was being anticipated. And we approached the SEC to increase that program to 1 trillion. Of course, I know people are in the room. 1 trillion does not mean they are going to issue everything at once. There was a 500 program. So let's say they had done up to 450 out of the 500 and now wanted to do 100. So that means it would have taken it to 550. Okay, we approach the SEC saying we want to increase that 500 to 1 trillion so that the total program of the state is 1 trillion. And then when we issue that 100, what you now have is 550. But the SEC was like, no, the 500 is 500. That is the document. That is what all the investors have. That is the resolution the House of Assembly that was gazetted. You need to do a new 1 trillion independent program that is separate from that program. You cannot consolidate that program into an increased program. Do you understand? I didn't get your name, so I don't know if you can hear me.
Yeah, my name is Samuel.
Hi, Samuel. So Samuel, so we now had to do a fresh and then go back to the House of Assembly, get the ESCO resolution. We did everything for a standalone 1 trillion program.
Yes.
And it was from that program that.
Sorry to interject.
Go ahead, please.
You know the whole process
yes.
you mentioned, right? Going back to the House of Assembly and all that. And
yeah.
when you are pressed for time, how do you go through all that?
Well, you have to do it. That's why I said, is this state? And state issuances are also political. If you're working on a supranational bond with a state and you want to rush everything through, some people would think that maybe there's something you're not telling them. So even though this one was time bound, we still got it done. The ESCO just had to explain to them. Of course, if you have a bad relationship with your ESCO, even if you don't want to go back and you're trying to do it in a different means, people have political groups. Somebody's going to say the state is trying to issue this, and they don't want to come to us because they are going outside what we had approved. So even if you did not want to issue a brand new one and the SEC would have allowed you to go outside the 500, for example, and you just wanted them to allow you increase it to 550, the SEC will still require approval of your ESCO and gazetting and everything to even put a little on your 100 or 500 billion. Do you understand what I'm saying?
Yes, I do, ma'am. I'm sorry to.
Because it's like a checkbox. Go ahead.
No, I was saying sorry to any other person that wanted to ask a question or something. But before you made this point, you said something about changing trustees. Like if you want to appoint an additional trustee, you want to remove a trustee. Typically, my understanding is that in transaction documents, they are usually deed of accession, right? So you don't need to amend and restate. So if there is something like a deed of accession that allows you to add an additional trustee, or say an issuing house, or something of that sort, is there nothing that can, something like that, that can work in that mechanism for increasing?
No, I think it would be interesting to examine that. But if you've not come across something or it has not been done a certain way, you can't say no, it can't be done, because these transactions are very dynamic. It depends on who is looking at the documents and who is insisting. But in my experience, we've not had a situation where the site itself was just outside the program, because you have the program. Each series, like you identified, is different. So like where the program was going to be. So exceeding the program, for example, is different. So let's do it this way. Let's say you have a total program of 100 and you had done, let's say, 80, but you needed 25 billion, but you have only 20 left in the program, and you were considering just getting that program increased so that you can get more money. I'm sure the advisors will tell you, don't bother. Still go for your 20, because you're allowed to take on over subscription. Do you understand? Do you get it?
Yes, ma'am.
So, but it depends on if the margins are way higher. Like this Lagos State bond was supposed to be 100 billion for the general bond, but they eventually took in about 115. You understand? But of course, we had the room to take it. But if it's an oversubscription that is, because for corporates, you would see that the resolution would have a portion. Can you hear me? Hello? 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 Hello?
Yes,
can you hear me?
Yes, ma'am. Can you hear me now?
Yes, I can hear you now. I lost you for a bit.
We can hear you, ma. We actually lost you for a second when they and they changed.
All right, it's okay. So I was trying to distinguish between if the offering is like a state bond or a corporate bond, because for corporates, even for their issuances, IPOs and everything, they usually have this general clause that also authorizes the company to take on oversubscription up to a certain amount, all those things. So, but for the state ones, it's just slightly different, the consideration, because of the public interest and the requirements for this. But I'll be happy to consider another option. Maybe after this we can talk and you can tell me what exactly you're thinking or what the issues are. But I don't have that answer.
Okay, no problem.
My hands are up.
And so one or two people have requested for your contact information. I don't know if it's okay to share your email with them.
It is okay. My number is on our website. All my details are publicly available. It's beg@spa@jibade.com. And I'm Bukola IG on all platforms, Twitter, IG, Facebook. And my number is 080-999-00344. But if you get to our website, you see it there. And you can share it with them in your participants list. That's fine.
Oh, thank you so much, ma. I want us to come online.
My pleasure.
Okay. I would like us to come online and ask our online participants if they have any questions. Okay, I can read a question from I can see a question from Emmanuel. He's saying, thank you very much, ma. Please, I would like some insight to the distinct operations of the Nigerian capital market and the Nigerian stock market.
Okay, I will try. So I'm assuming that when you hear Nigerian capital market just talks to, encompasses everything and everybody that participates in the market. It's talking about the capital markets of the Nigerian economy, meaning that the regulators, the issuers, the capital market operators, the professionals, the products, the brokers, the registrars, the exchanges, Nigerian Exchange Limited, which is the Nigerian Stock Exchange. I don't know if that's what he meant by Nigerian stock market, or he wants us to delve into the stock market itself. I will look at the Nigerian Stock Exchange. So if you can add something to that. So the Nigerian capital market encompasses all that and all the financial products that are available and how the market is doing vis-a-vis looking at other markets in the region or globally, the the New York Stock Exchange, the LSE, and other markets in the region. They will look at, when you're looking at the Nigerian capital market, that's what you're discussing. Even the fintechs. And I'm sorry, I think in my, I don't know if we finished or it's still in one of the slides. You know that you now have fintech products, you have the sandbox. SEC is encouraging more startups and fintechs to also enter the market and get funding. We have the crowdfunding rules as well. So, and you have the portals for also raising capital via crowdfunding. So all those things, including all the existing rules and products, form the capital market. But then when you're talking about the Nigerian Stock Exchange, which is the Nigerian Exchange Limited now, NGX, it's been split, it demutualized in 2001, and then it's no longer a company limited by guarantee with members. The stockbrokers were the members of the exchange. It's now a limited liability entity, and they have the exchange, they have the regulation limited, and they have the real estate. The real estate holds their properties and other assets, and the regulation deals with, because you know, the Nigerian Stock Exchange, which is Nigeria Exchange, is an exchange, but it's also regulated because it's a participant in the market. So it's also a member of the Nigerian market, as well as regulating its listed entities. So the Nigeria Exchange is like FMDQ now. It's also an exchange, but they are all members of the Nigerian capital market. But if you're talking about the stock market as separate from the exchange, it just means that you're looking at only buying and trading and investing in shares and other securities. So meaning that, oh, you're looking at listed securities, you're looking at unlisted securities that are traded over the counter, you're looking at the stock market and how it operates. Well, how can I buy shares? How are my shares dematerialized? Or do I have a CSCS account? I can, during an offering, I can purchase shares, I can sell it. That is the stock. You're dealing in like securities and shares of companies. But we use stock for only equities, but it actually covers other things. So I don't know. I wanted a follow-on question for you to confirm what exactly you meant by Nigerian stock market. Emmanuel,
I hope you heard that. Do you want to come online as well? Maybe ask your question in person, turn on your video and ask your question. Or can you just type a response so that we know if that answer was adequate? Emmanuel, are you there? Okay.
Maybe we can move on. You can always send me an email or something.
Okay, that's great. Any other questions from the room? Okay.
Yeah, I'm here. Good morning.
Oh, okay.
Hi.
Before you
Thank you very much.
before you ask your question, sir, I just want to point out that she has put up our email on the group chat. So if you are on the virtual group, you can see our email. I'll always send her an email to contact. Then we that are in the physical class, you have a number. We will also share our email with you if you need it. So please now go ahead and ask your question, sir. Thank you.
Thank you very much. Just wanted to get more insights to the distinct operations between the Nigerian stock market and the Nigerian capital market. It can be a little confusing. I would really appreciate if I can get the clearer insights to the operation.
She just answered your question. Were you listening? I guess you must have missed it. She answered the question and she answered it in-depthly. So I was wondering, you probably...
I'm sure I missed the response. I really apologize for that.
Okay, but she
so what I needed...
Yeah,
okay,
please.
sorry, I did. Yeah, so I want... sorry.
Bless you.
I wanted clarification on whether you meant Nigerian stock market or Nigerian Stock Exchange.
Yes, ma. I meant Nigerian stock market, ma.
Oh, you meant stock market, meaning dealing in shares.
Yes, ma.
So what I said was that the Nigerian capital market encompasses everything in the Nigerian capital market, meaning the regulators, the issuers, the capital market operators, we the professionals that engage, the different types of securities, the different exchanges, the OTC market, just everything generally, because it's also a barometer to see what is happening in the economy. And you also see what is happening across the region in other exchanges. So people will look at the all-share index of our exchange and other exchanges, look at what is happening generally in our capital market. And when the economy is down, we also see it in the market. For example, people are not so sure. You don't see a lot of private equity issuances. You don't see IPOs like before. Nobody is going because you don't want to list your shares and then your company valuation is down. So you see people accessing the market, some stronger companies, people mop up their shares because they're happy that somebody is even selling shares. So everything as a whole is the Nigerian capital market because you have different types of securities. It's not only shares or companies, you have bonds, you have other financial products that are you have derivatives, you have different things that are going on. That is the whole as the Nigerian capital market. But then if you are looking at just stock, so that means that you're concerned or interested in how maybe buying shares or other securities, trading them, holding them, maybe your accounts are CSCS and how all that operates. I think that's where you'll be looking at only the stock market. And those shares are not only listed on the Nigerian Exchange Limited, the NGX, you also see them on NASD, you also see at FMDQ. So different exchanges hold. So if you go to those exchanges, you see, for example, I think is it the NASD? They have different types of companies, the way they look at them. I think FMDQ as well. You have blue, you have pink, you have red, meaning that the blue are the companies that they provide a lot of disclosures to the exchange. They have information on them. They have 5 years accounts. Pink, they give some information, but not a lot. Red, they don't even give any information. So if you are trading or you intend to buy shares of those companies, they are telling you that we don't know much about them, but you can buy into them. So all those things, that's about the stock. You just want to buy, invest, trade. That's about stock market, but the capital market is wider and encapsulates a wider. I don't know if that's helpful because I feel like I'm waffling now.
Yes, ma'am. Thank you very much, ma'am.
Okay, all right.
All right, ma'am. So we have about 2 more questions. This is one.
Okay.
Thank you so much, ma'am. Good morning. Thanks so much. I wanted to ask about Suku. You mentioned that it is a religious point. So I was wondering, religious, do you mean literally or metaphorically? So I don't understand what Suku.
She's not very loud.
Okay, can you hear me, ma'am?
Not audible.
Okay.
Yes, better now.
Okay, thank you. So I was asking about sukuk. I wanted more insight on what sukuk is. You mentioned that it is a religious bond, and that threw me off. So I just need a little bit more insight on sukuk. Thank you.
Okay. I won't call it, let's not, maybe I don't want to say religious and confuse you. So you just like you have general bonds, you also have some things called green bonds, and you have sukuk. So if you hear the word green, it's supposed to tell you that transparency is sustainability linked. Like when we worked on the federal government green bond, it's a bond that was issued by the Ministry of Environment for infrastructure required for some environmental needs. So you might see issuance for maybe, should I say, housing. So let's say you know a lot of young people now, if they want to purchase a house, they probably need to have nothing less than 30-something million to subscribe to some of these real estate companies. But then someone can come and say, look, we want sustainability. We want to give housing that is not expensive so that most people can get out of rentals and we can reduce homelessness. That means the company is saying the reason for this issuance is linked to some sustainability issue, part of the goals of the maybe UN goals and everything. So you're tying down your issuance to some good and sustainability issue. So those ones are called green bonds. Sukuk, under Islamic law, I don't know, someone should help me. I think I'm a bad Christian. Even in the Bible, you're not supposed to charge interest when you loan people money. So under Islamic law, you're prohibited from taking interest when you loan money. So most of the products available, if you're a strict adherent and you want to do halal investments, you know what halal means. Just like if you want to eat meat and you want to do it properly, you're supposed to eat meat that the blood was peeled. So meaning that the goat or the ram, they killed it properly. But for a lot of things you buy, you're not sure whether they have done it properly. So they call it, if it's done the right way, it means it's halal. So when you see some funds that they say is halal fund, it means that it's clean. The fund does not include securities or investments in maybe alcohol businesses. It does not invest in like smoking or they don't sponsor porn or prostitution rings. They are not into anything that is not clean. Their investment is clean, is halal. So in the same way, when you have the sukuks, they have different, you have the different types of sukuk, which I encourage you to go and read because it's outside the remit of this our class. So you will notice that the aim is to ensure that the fund is not polluted by charging interest. So participation, what you're doing is you are participating. So let's say I want to build a toll gate and I need 100 billion for the toll gate, but I'm going to be collecting money from people to use the toll gates. Instead of doing a regular bond where I will state that the interest on the 100 billion is 15-point-something%, the financing will be structured in a way that when I give you that 100 billion, you will do the calculation on the money you'll be getting from the gate takings and work out how I will be participating with you in sharing the profits from the toll business. Do you understand? At the end of the day, for the conventional financiers, they have their way of saying, okay, if the person is sharing in my profit and loss, it comes down to about so percentage. But in the real terms, when you're structuring the sukuk to be compliant with Islamic law, you're structuring it to ensure that it's not whatever you get on the money you have advanced is not an interest, but it is rental income from providing you the fund. I don't know if you understand it, but if you don't, we can take it offline. You can also do additional research. I don't know if that's clear to others. Hello?
Yes. So
somebody help me.
Can you hear me, Ma?
Yes, I need someone other than Ade to confirm that it was clear.
She said it was clear. I am just re-echoing what she said, Ma. She's the one confirming.
Okay. All right, thank you.
So we have one more question. I think that will be the last question.
I would like you to talk a little bit about the materialization of shares.
Okay.
She mentioned the materialization of shares.
Yeah, so just basically, under CAMA, the rules were that once you issue shares to a shareholder, you need to issue a share certificate to as evidence of the shareholding. And also under the SEC rules, the previous SEC rules, when you have capital market issuances as well, and the allotment proposal has been approved, you also need to issue share certificates. In fact, the registrar had a duty of ensuring that those share certificates get to the subscribers. You had cases where you have stacks of share certificates with the registrars for years and nobody will collect it, or someone dies and they don't know where their share certificates are and they are asking you to bring the share certificates for you to be able to have access to claiming the shares. So over the years, the SEC thought it wise that to avoid all these issues, like is going on in other countries as well, it is important for these certificates to be dematerialized, meaning that the share certificate is no longer in a physical material form, but it has now become like electronic, in the sense that you just, when you fill the form, you give them, when you are subscribing for securities, if you don't have a CSCS account already, that's the Central Securities Clearing company, you will now you open one. So once you subscribe, automatically your account will be credited with those number of shares. And in the same vein, instead of issuing you a dividend warrant or your coupon or something in a paper form that maybe gets missing in the mail, or after some months, it becomes stale because you did not deposit it on time, and then you have to go back to have it reactivated. Now your payments will also go, because at the same time, you will also indicate your account on the document to instruct them that all payments due to you should also be credited electronically to your account. So that's just it. It's just the process of ensuring that share certificates are no longer issued in physical form.
Yes, and the final question from the room.
And then,
can you hear me, ma'am?
Yes, I can.
Thank you very much for that very wholesome and concise lecture. I just wanted to say, Ma, can you shed more light on the difference between rights shares and bonus shares?
Okay, I think I was the one that confused you guys the other time. So basically, like I said, the explanation I gave regarding the rights issue is just that when the company wishes to raise additional capital, they would have a rights issue, which means that the existing shareholders, based on their shareholding, they will do a pro rata issuance. So let's say we are 5 people and we have 10 shares in the company, and the company decides that, oh, they want to raise 1,000 naira, and we each hold 200, let's say 2 shares each. So it means that if those shares are 100 naira shares, they will just send an offer to each of us saying, come and take up your 2 shares from these 10 shares that we want to issue. So if you now decide that I don't have money, I don't have 200 naira to take up these 2 shares, then other shareholders will be able to take it up. And if all shareholders now say, oh, we cannot afford it at this time, they can now decide that if the company really needs the capital, that they should throw it out to external people. So that means that you have issued additional shares and you have received additional capital into your company. So it will affect your capital. However, for bonus share, they're just going to issue shares to all shareholders, which you will not be required to pay for. But the thing about the bonus share is that it's going to affect the company and the valuation, because it will adjust. So you would think that if you had 1,000 shares and you now issue and the value was 1,000, if you issue additional 1,000 shares, it will not become 2,000. It will just become 2,000 shares at 1,000 valuation, because you did not get additional income. You just issued more shares and you gave it to your shareholders pro rata. Do you understand?
Yes.
Forgive me for the earlier vision, I was rushing.
Yes, ma'am. There's a follow-up question as well, ma.
Thank you very much for the explanation. My question is, rights issue, are they always at a discounted price? If it's offered, to the shareholders, rather than sending it to the public. My understanding is that if it's given to the shareholders as rights issues, it's at a discounted price. And when it's taken out, if they don't take it and it's thrown to the public, the price is higher. Is that correct?
I think you can't have absolutes. So we've had cases where it was discounted. So if you have like an offer for sale and a rights issue, because you're already in the company, and for example, if the company has not declared dividends in a while and they want to do a rights issue, the shareholders will be more amenable to it if they can see the obvious discount, because that's your way of giving them income. So you can see an offer for sale might be, let's say, 5 naira per share, and the rights issue will now be 4 naira 20 kobo, because that's acknowledging the value that the shareholders have put in the company, and it's a way of giving them something. So, but it doesn't mean that you cannot see a situation where rights issue is the same as the offer for sale, because it's also ensuring that the shareholders' position doesn't reduce too much because you are bringing new people in. That's also part of the work of the rights issue, so that they can also bolster their position in the company. People are asking me a lot of
technical
practical broker questions that are not my lawyer questions, but I'll continue.
Well, thank you so very much. Thank you so very much. I believe we've exhausted all the questions in the room, and I believe we've done so with the virtual participants as well, as I cannot see anybody raising their hands. Please, guys, a round of applause.
Thank you.
We are most grateful that you've taken your time out of a very busy schedule to present this masterclass to us. Thank you so much, Ma. It's been an honor to have you. And can you guys just say thank you to her, please?
Don't force them. If they are not happy, don't force them.
They are happy. They are happy. They have smiles on their faces. So thank you so very much, Ma. We'll humbly release you now because we know you have meetings scheduled for the rest of the day. But thank you so very much. And of course, we'll definitely be in touch. Thank you so very much, Ma.
All right. Thank you, guys. I'm wishing you all the very best. See you around. Bye.
Bye-bye, madam. Thank you.